three things I want to cover in this webinar, and that's time frame analysis, analysis of the weekend, and trade reviews. And basically, the reason why these three are together is because you can't separate them. I believe, and I still believe, that the road to consistent trading, and one correlation I've always seen, even with people who I've been training and teaching, and the one weakness I've always seen is they fail to do these three things. And I can promise you now for free, if you do not do these three things, you can forget about trading profitably or consistently. Hear me clearly as I say this. If you do not follow these three steps, you will never reach consistency and you will never trade profitably. I'll say it again. If you don't do these three things, you will never trade profitably and you'll never trade consistently. And I know this for a fact because even with students I've had for 3 years, they still don't do these three basic steps. These three basic steps are: number one, you do an analysis over the weekends, you take your trade during the week, and then on Friday you review your trade. So for example, say this was my weekend, what I would do is I would first do an analysis, right? And so we're going to dive into time frames and things like that, but it starts off with analysis on a Saturday. And you want to make sure you do your analysis over the weekends on a Saturday and a Sunday. The reason why I emphasize that is because you've planned out your trade. Essentially, when the markets start moving, you will get so confused that you'll end up swaying this way and that. So you'll find yourself entering trades, then exit, enter, exit, enter, exit. You need to have a game plan and you need to follow your strategy. And you need to stick with a position. Once you've decided that's how you're going to enter, then you stick with it. And so once you've analyzed over the weekend without the noise of the markets moving up and down, and believe me when I tell you, on Monday, everything goes haywire. When the markets open, things go haywire. And it's terrible to try start doing analysis on the day you're placing a trade, because you want to take a step back. On Saturday, say you review the markets, go through some pairs, and then on Sunday you want to make a list. So on Saturday, when you do your first round of analysis, you want to make a top 7 pairs of the pairs that really look good and the trades that really look nice, right? Once you have those 7 pairs, you want to say cancel some correlated pairs to reduce your risk. Meaning, if you made a list of 7 pairs on Saturday from your analysis, if 3 of them are euro trades, pick the best euro trade. Don't place all 3 euro trades. Reason is because if euro goes the opposite direction, you have just multiplied your risk 3 times, right? If you have 2 US dollar trades, cancel one, take one, because you're now placing 2 US dollar trades, which are essentially the same. And if it goes against you, you're risking twice or 3 times your normal risk. Number 3, you should understand correlations. We're also going to get into correlations because it's important to understand correlations. And what I mean by that is you don't want to be trading against yourself. So 2 uncorrelated pairs is gold and the US dollar. If you're going to buy the US dollar, go through the gold chart and ensure that the gold chart is going the opposite direction, right? Hear me again. Gold and the US dollar have a negative correlation, which means when the US dollar goes down, gold goes up, right? When gold goes up, the US dollar goes down. When gold goes down, the US dollar goes up. They're negatively correlated. And it just comes back down to investments. When the US dollar is performing terribly, most financial advisors, they tell their clients to invest in gold. Gold has always been a safe haven. If you want to open the gold charts, you will find during this COVID time that gold has spiked up and the US dollar has gone down drastically. If you want me to open a chart, I can quickly do that and show you before we head into the real business. But it's important for you to know that even while you're doing your analysis for the weekend, this is during COVID times from around about March. Gold was going to flop from this point here. This is when COVID started. Look what happened. Gold moved up, right? Now take a look at what happened to the dollar index. The dollar index is basically the gold's currency against other currencies. So you should also have it on your charts. It basically just tells you the strength of the gold, the strength of the US dollar, sorry. So if we go down to where COVID started, so like I said, if gold and the US dollar negatively correlated, we expect to see gold to have dropped when COVID started. So that's around March, January, February, March. Right here, as we enter into March, when COVID started, look what happened. As gold was rising, the US dollar has been falling, and it's continually falling and falling and falling. So it's important to know that over the weekend when you're doing your analysis, so when you're trading gold, you're also looking at the US dollar. And it's important for you to know so that when you're placing trades, you aren't placing trades against yourself. So, and this is very important because I've seen traders do this. They will open a euro pair trade and say they've sold it, and then they're buying another euro trade. So essentially, they're going to lose one and win one and make $0. So you want to not trade against yourself by trading. If you're going to trade one correlated pair, trade in one direction. If you're going to buy the euro, you're buying the euro. You can't buy the euro rand and then sell the euro yen, and then buy the euro pound and then sell the euro franc, right? So we're going to get into correlations later on in the other webinars. But right now, what I want to show you is that, say it's a Friday, in fact, say it's a Saturday, and the pound is a pair we've looked at, and we said, you know what, this looks nice. First of all, on time frames, it's important to start off on the higher time frames. You want to do multi-time frame analysis. So you want to first look at the larger time frames before you look at the lower time frames. So what we can see is that obviously the pound has been falling for the past decades, right? But here's our focus. This area here is our main focus. This is the main few weeks. And so what we've seen in the past few weeks is this huge downtrend. And then this uptrend, which is very unhealthy looking, but it's still a bit of an uptrend, right? So we start off by drawing the basic support and resistance. As you can see, price hit this area here, hit this area here, hit this area here, hit it again, right? Remember, basically support is like a floor where price touches and then it bounces up, right? Resistance is a ceiling which pushes price down. That pushes the price down. So we've essentially seen that we've dropped from this area all the way down to this area here. Still marking our support and resistance. This is the major area we need to focus on. This area here and this area here. And then we want to see if there's been a pattern in this increase here, this uptrend we're seeing. So we're seeing sort of this pattern here. And you'll see that I focus a lot on patterns because patterns tend to repeat themselves and they're more consistent. So here we go. Right. Now let's zoom in. So we've seen this downtrend. We're looking for either a continuation to the uptrend or a continuation to the downtrend. Zoom in. What we've seen price do consistently is that it's been trapped in this area, right? It's been trapped by this resistance. And remember, a lot of people teach resistance as support and resistance as horizontal. So these support and resistance, but support and resistance isn't just horizontal. It is also vertical, and it does look a lot like these patterns. So price has consistently been touching this resistance area here, and then it's done so again. And now we're at a critical point, and two things are either going to happen. Either it's going to drop to the downside, or we're going to go back and test this level, and then test this level we have already talked about. So what do we do next? We've identified a pattern. As you know, I like patterns a lot. So we're looking for a reversal to the uptrend. Now let's zoom in. For those who like pin bars, As you can see, we're starting to see some form of reversal. This was a bullish pin bar right here. Let's go down. Can you see this is an engulfing candle? For those who've been looking into candlesticks, this is an engulfing candle. Similar to what you'd call inside a bar or an engulfing candle, but mainly it's called an engulfing candle. And what happens with an engulfing candlestick pattern is that the last candlestick basically swallows the previous. Excuse me. The last candlestick here basically swallows the previous candlestick and changes the direction. So essentially, this is a bullish candle that's essentially taken out this previous bearish candle to show a reversal. So we've seen pound struggle, and now it's at this point here, right? So still things look bullish, right? We still want to confirm with other things. So right now we've looked at support and resistance. It's told us that pound's going up. We've looked at patterns. It's told us pound is going up. We've looked at candlestick reversals. It's told us that pound is going up. Let's look at some indicators. So I use the 8 moving average. Right now we're currently below the 8 moving average. And I also use the 89 moving average. If you're wondering where I got the moving averages from, there's a book called, I think it's called The Trading Bible. It talks about these candlesticks I was talking about, and also talks about these moving averages. So now we are challenging the 8 moving average and the 89 moving average. And importantly, I think I've said it, Dr. David Paul also considers an 89 moving average to be the beginning of an uptrend. So the minute we're above an 89 moving average, it's most likely we're now in an uptrend. And as you can see, we're very close to it. Compare that to when we were here, and this was the 89 moving average. So there was this huge distance here, and now we're closer than ever to start an uptrend. So once you've done your analysis like this on the weekends, you've done your multi-time frame analysis, you've looked down at, and then if you want to get into more technical analysis, this still looks like a head and shoulders, right? This being the right shoulder, the left shoulder, this being the head, this being the right shoulder. And so still this looks very much bullish. This bullish candlestick here, this other, I forgot what this, is it a doji? I think it's called a doji. This doji candle here, or gravestone, it's one of the two, doesn't matter, but just know it signals an up movement. And so that's what we're looking at. It looks clearly like an uptrend or a buy signal. So right, this still also looks like a bullish flag. So this would be the push up. This would be the consolidation of the bullish flag if there was, and this would be the entry. Somewhere below here would be the stop loss, right? Or better yet, you want it a bit below because you don't want your stop loss to get hit. So that's pretty much it. And then once you've done your analysis, then you start deciding how much you're going to risk. And risk is basically done in percentages. You want to stick to 1% risk, or even better, 0.5. So you've done your analysis over the weekend. You've looked at the time frame analysis, and after you've done that, you place your trade during the week. And then what you do on a Friday, right? So we've done analysis, we've placed the trade on during the week, on the Monday, on the Tuesday, whichever one it is. You've done those two things. On Friday, what you want to do is you want to see how your trade is doing. So you should have a journal where you record your trades for the week, and that's what you're reviewing over the week. You want to review whether it was a win or loss, what pattern you traded when you did enter it. You want to review percentage increase or decrease. how well it performed, is it still going, what's your target, things like that. And basically, what a review is, you're just analyzing to see whether you would have done things differently. Now, reviewing doesn't mean you've won the trade, right? So you could lose the trade, but you're still reviewing to see if you followed everything in your strategy. So number one would be trading a pattern or a strategy that you trade. It's a bad trade if it's not in your trading plan. If it's not part of your trading plan and it's not your strategy, then it's a bad trade, whether you win it or you lose it. That's what you're reviewing. You're reviewing to see whether you followed your strategy and your analysis, you stuck to your risk management, you're moving your stop loss to break evens, and you're following a trade so you're not giving back profits into the markets. We'll get into that later on as well. And we'll also get into how to keep good records and what you should be recording during your reviews. And that's what basically a review is. You're trying to see your performance over the week. And that also means that you can't overtrade, because if you overtrade, you won't be motivated to do your review. Overtrading is having more than three positions open. If you have more than three positions open at a time, or say the best way to know whether you're overtrading or not is if I ask you what positions are you in. If you cannot immediately tell me what positions you're currently in, you are overtrading. So essentially, you should never have more than three trades. A good start would be 10 trades a month, 10 solid good trades, focusing on good trades, 10 good trades a month, never having more than three good trades, never having more than three trades open at the same time. And someone will ask me and say, oh, isn't that trading too little? But what are you trading then if you're going to hold this position, for a really long time? Why are you opening so many trades if you're going to be holding this position for a really long time? There's just no need for it. And you'll end up making more mistakes than actually gaining. Please remember in trading that the more you trade doesn't mean the more money you make. Essentially, there's something called the law of diminishing returns in economics. And what it is that the more effort you put in past a certain threshold, you'll start to get negative results. It's like if you start training today and you start, say, you start doing 30 push ups. At some point, you're going to stop doing those push ups correctly, and then you're going to start straining your back, and then you're actually not doing anything and you're just doing half efforted work. So that's essentially all. Think of it this way: say you're a student and you're studying. The first 5 hours are your most productive hours. Once you're studying more than 10 hours, essentially you're staring at a page and you're not actually studying. That's what negative returns is. So that's the breakdown of my entire process. So remember, I'll say these three things: analysis over the weekends, Saturdays and Sundays, right? Make um, your short list of what you're watching for this week. You should be able to tell me what you're looking forward for this week and your analysis for the week. Basically, it's like trying to predict what's going to happen based on your strategy, right? Remember, trading isn't predicting what's going to happen, whether it's going to go up or down. That's none of your business. Your business should be trading your strategy and your plan. And that's what you're looking for over the weekend. It's not whether you're right or wrong. It has nothing to do being right or wrong. It could be part of your strategy and still be wrong. I mean, it could be part of your strategy and you still lose. It could still be a pattern you've traded 100 times and you could still lose. So please remember that. Analysis over the weekends, shortlist to 7 pairs by Saturday, and then Sunday have up to maybe 3 to 5 pairs that you're looking at and that you're trading for the week. And then during the week, you enter your data into your trading records during the week, and Friday you review your trades, going back to the charts, seeing what you could improve on, what you did wrong. Um, what you did wrong could include entering too early. It could include having too tight a stop loss. It could include not looking out for the fundamentals during the week. That's what reviewing is. It's basically seeing where you could have improved and done better. Now, if you're going to follow some of my students who don't do that, essentially you're not learning. The process of learning is to make mistakes and learn from them. Now, if you don't learn, you're just placing trades and placing trades and placing trades, and nothing's going to improve. Because the only way you're going to see errors is if you review. If you have a certain problem, I used to have a certain problem of entering early. So after I started reviewing that, yes, I was correct, but I was entering too early, getting stopped out, and then the price would go in my direction. The strategy was right, the trade was right, but my entering was terrible. That's why I started learning divergence and how to enter it properly based on what suited me. That's why you review trades. So that's pretty much it for now, guys.